And so, for instance, we'll bring back this French thing that I've harped on over and over, and there's a reason. There's always a reason I'm harping on something for a long period of time, but I like to keep things simple. And when you go back in monetary history and just use the French model with the assignat pre the collapse, the economy would be doing badly. The government would meet. It was always the same solution. Let's just print some more money, and the economy would get better. I mean, it genuinely would get better for a while, Bill, but as you know, that would roll over. And each time it would get worse. And the agreement was always the same when they would meet. Let's just print more money, print more money, print more money into the collapse of that currency. That is what monetary history teaches us happens when you keep things very simple.
So, Eric, let me summarize. In 10 years, the stock market's gone nowhere. The dollar is down roughly 30% against a basket of other fiat currencies. Gold is up 3.5-fold. Oil's up 4-fold. The GDP's up maybe 28 to 30%. And we've added, a little over $6 trillion in debt to the system. So I would say that the 10-year report card with regards to the interventions beginning back in 99 with Y2K and Greenspan have been a complete, utter disaster.
And then the question becomes, Bill, what are the ramifications? And I'll pose this to you now, but then what are the ramifications? Because, as you know, what Jeremy Grantham said from the very beginning, listen, and maybe not everybody agrees with this, but we should have let everybody collapse. We should have let the system collapse. It would have been hard. It would have been depressionary, but you could have cleansed all this out. Assets would have gone for pennies on the dollar. We could have restarted from that base and basically had an upward economy from that base. Now, granted, it would have been a horrible base, and it could have been at the bottom for quite a while, but the point is we would have been restarting from a cleansed process. And instead, what the Fed always does every time is have another bubble. Let's have another bubble. Let's have another bubble, and let's just keep printing and printing and printing. Now, my question to you, Bill, is what are and this is a hard question, but what are the ramifications of that? The fact that you have a government that instead of letting the system be cleansed and starting over from a healthy point has continually built one bubble after another, after another, after another. What is the ultimate exacerbation? How bad do you think the fallout because you're going to hit the wall. It's like a gambler. You're going to hit the wall eventually. How ugly will that be is my question for you.
Yeah, I think that we're closely approaching that tipping point, if you will. I mean, basically we have the real economy trying to get access to capital, and the government continues to crowd out the real economy. That's going to pressure the real economy, hollow out the real economy even further. The amount of money that is pouring into the hands of the Wall Street dealers, who are really nothing more than the puppeteers, and the puppets are the D.C. crowd. And so you have Goldman Sachs paying themselves $23 billion in bonuses, and Lloyd Blankfein is writing an op-ed in the Financial Times talking about how he is, doing wonderful things to help the economy get back on its feet. But you think about that money. That is a lot of it is just taxpayer money, just handouts, bailouts. So it's a very distorted, unpopular process by which we're going about this. We know that the dollar has been bleeding this year against a basket of currencies, especially against the commodity-oriented countries. We know that the gold price, since we last spoke, hit an all-time high 2 nights ago at, I think, 1,070, 1,071. The gold market is basically saying that there is no confidence whatsoever in the developed world governments. The science experiment that they've undertook has horrible unintended consequences, and it's not just here. It's Japan. It's the UK. These are the developed world governments and their completely brain-dead ways of approaching the crisis. I agree with Grantham. There could have been a process put into place where we take the money centers, they go into some type of a receivership, we unwind years of misallocated capital. At the same time, you could create some community bankers with new capital that could actually get capital to the viable businesses. Instead, we're going back to the existing community banks and saying, prepay 3 years of FDIC insurance because the FDIC is completely upside down. And, of course, that money is going to who? The Wall Street people. The money flows back through Wall Street. And it's a complete misallocation of even more capital. The problem is, again, I think we mentioned this last time, the balance sheet of America is precarious at best. We don't have the balance sheet to even attempt this process. So, yes, we've had a stock market rally. I had a friend say, Bill, the reason why money's pouring into stocks is because it's the only market that hasn't really been completely destroyed. The stock market is kind of the last kind of bastion of speculators, if you will. And it's pretty easy to say that that's been true. We look at the activity in stocks like AIG, Fannie Mae, Freddie Mac, all the volume, Citigroup. These are insolvent businesses where there's no equity whatsoever, yet that's where all the volume's been over the last 90, 120 days. But I think that's kind of some of the unintended consequences. And ultimately, the currency just buys less of what we need to live. And so the standard of living of the country drops radically.
I think the key point to hammer home here, which is what you're doing, Bill, is basically to say that as you forestall something, it sort of reminds me of a heroin addict, and people use this example. And basically the idea here is they're a heroin addict, and what we need to do to keep them cool is just keep giving them heroin. Let's just keep giving them more and more and more heroin, and things will be okay. And you and I both know, well, that's not a real practical solution. And instead of having this cleansing, which would have meant a depression, everybody understands that, and that's horrible, and there's a lot of human suffering. But the problem here, Bill, is we took Plan B, which is just, let's go to these other mid-range banks, like you said, some of whom were responsible, and not only have them prepay 3 years of FDIC fees, but did we mention that instead of having a $600,000 fee for 2007, it's about $8 million for 2010. So let's have them prepay 3 years of grossly, absurdly ratcheted up fees and a socialization where we take from the healthy banks that were responsible and we feed into this monster. And also, did we mention that we've hollowed out the economy, the industrialization is gone, and nothing we are doing now is bringing back the industry, or what the Austrian economists would say is a healthy economy. We're not doing any of those things, Bill. We've just hollowed things out, and the idea here is we're just going to pump up another bubble and keep this rolling, right?
Yeah, they're going to try and pump up another bubble, but I think ultimately they're going to fail. The credit bubble was one for the ages. You had real estate as the underlying collateral, and that enabled mass credit growth via the mortgage conduit, and that flowed over into other assets after real estate had gone up several-fold in certain parts of the country. But, after a bubble bursts, and then, of course, the Fed responds with even more money printing, usually the money doesn't flow back into the prior bubble, so we're not going to see a real estate bubble again. You're granted you're getting speculators just like you did in stocks after the tech bubble burst. But I think the disconnect, I guess, is between the real economy, the crowding out of the real economy. If you look at a number of metrics there, and then look at the stock market, you have the same group of people that did not see this coming several years ago walk their clients into the fire, calling for $100 in earnings in the S&P. Of course, the market went down radically. And they're the same people calling for $75 in earnings next year. That's not going to happen. And if you do get $75 in earnings, a lot of it will come from the financial engineering going on within the money center banks, which I think everyone knows are made-up numbers. I mean, when you're rolling back mark-to-market accounting and you've got money priced at zero, of course, anyone can create an illusion that they're making money. But delinquencies keep going up, foreclosures keep moving higher. That's primarily where, banks have over 60% of their loan book in real estate. That's where the exposure is. And we're not dealing with the pain yet. So I think we have a long way to go. Unfortunately, they're going to try and keep the money centers propped up, very similar to Japan. Therefore, the real economy will continue to suffer. And we probably go into a period of time where the stock market rolls back over. Government meets that decline with even more bailouts, and that's essentially going to pressure the dollar. Look at the creditors that are hitting the airways of late. The Chinese, the Japanese, and the Middle East are all basically threatening to stop taking dollars, and or the Chinese activities recently